G'day everyone, I'm Nick Cervetto from JHK Legal in Sydney, and today I'm lucky enough to be chatting with the top buyer's agent in the country, a man who loves all things property and also happens to be a long-term client of JHK Legal, Paul Glossop from Pure Property. Welcome, mate.
Thanks for having me, Nick. Mate, yeah, good to be on board. Very, very generous introduction.
Now, mate, look, I know that everyone's kind of sick of talking, COVID and what's going to happen and blah, blah, blah. But just for those people who don't know you, may not have seen you before, I remember in April, May, June last year when kind of all the big four economists were sitting there shouting 20, 30% price drops, decimation of the residential property market. You turned around and basically said, look, we're looking at possibly, a 4% drop, mild drop, and then leading into a prolonged period of 15, 20% higher growth, didn't you? You've almost picked that to the T.
Yeah, mate. Yeah, it was probably April last year. We went out on a limb, and it wasn't just a hunch. It was essentially using what data we had on hand to say what's happened in Australia, and even more so globally in major economic impacts. And obviously, COVID's been something that's definitely reinvented record books and expectations of what happens when you change the economy literally overnight and change the way that we operate, change the way that businesses do business almost immediately. And we basically looked at what the last major five downturns were going back to the 70s, and the average 5-year growth period of property globally, but more so in Australia, on average was about 33% following that. So there wasn't really any other signs to say anything other than what has happened previously would happen again, which is essentially things like mass stimulation, mass amounts of money being pumped into infrastructure, jobs creation, cheaper money, liquidity, bond buying, and all the things that essentially we've seen and will continue to see over the next few years, which are there to stimulate the economy and stimulate the housing market, because ultimately the housing market is one of the quickest triggers that any government will ever have to get things moving. And that's what we saw, and that's what we put out there on the record. And ultimately, clients of ours are doing really well out of that.
Yeah, absolutely, mate. And it is stimulated. Half the country right now is in lockdown, but it kind of doesn't seem to have made a dent in prices at all. Do you think that is purely related to the lack of stock on the market right now, or is this something that's going to continue into the next year or so?
It's definitely lack of stocks. I mean, ultimately, supply is the enemy of capital growth in any market. And when you don't have much supply or enough supply to meet the market's demand, you're always going to see price growth regardless of what property type it's going to be. So it's definitely been one of the big factors. But in saying that, we've seen record amounts of new building approvals. So there is actually new property coming to market in masses. But it is most certainly the shift towards freestanding houses and larger properties, because people are clearly, as you and I are right now, doing a lot of their business from home. It's not a permanent fixture, but it will be definitely a way that's changed forever. So that, in addition to the cheap money, changes to where lending regulations come into the fold. And probably one thing that I think surprised a lot of people is that the expectation that Australia is a country built on migration and that extra people come into this country on a monthly, weekly, annual basis, however it looks, is what puts more pressure on the housing market. But the reality is we're running at a net deficit of how many people are actually entering Australia over the last 18 months. So we actually aren't seeing the same level of migration in as what we normally would see out. And people are probably becoming more surprised that, well, how does that correlate to price growth? If you haven't got as many people coming into the market, how does that mean we've got more demand? But ultimately what it's meaning is that people who are living in a 2-bedroom property now want a 3-bedroom property. People who live in a 3-bedroom property now want a 4-bed plus a study. People who don't have a backyard want a bigger backyard. People who aren't by the sea or only by some sort of amenity where their kids can get outside or they can get outside and enjoy themselves are now seeking those things. So jobs as well as supply, it's throwing a few different curveballs at us, but most certainly supply as well as the demand is what's pushing this up. And we don't see it changing for at least probably 12, possibly 24 months in some of the major markets.
And is that that was actually going to my next question, the migration stuff, if it does, even when we do open up, get back to normal, whatever it might be, or start getting back to normal, do you see a bit of turbulence going on in America, a bit of turbulence going on in Europe and things like that? Australia is quite an attractive place for people. Do you see that migration, being the next catalyst to continue this going for longer than people expected?
I think so. I think that's the ace up the sleeve of the government at this stage, is saying that, well, once we are ready to roll, and we're probably only 4 to 6 months away from welcoming skilled migrants back into Australia, fully vaxxed, and once we get to that 80% threshold and all the other things that we're talking about for easing up of border restrictions, I think we're going to see a flood back. I mean, we're already seeing skilled expats who have moved overseas for higher paying jobs or promotions, etc., sort of now looking at Australia saying, well, even if it is an equivalent job, I probably prefer to live in my home country knowing everything that Australia's got to offer and provide. And in addition to that, I think the skilled migrants who were coming here are going to come here, if not on the same level, at a higher level. The student level is going to increase again as well. So those markets are probably a little bit soft, where there's not many of them at the moment, be it the inner city apartment markets of Sydney, Melbourne, predominantly, because that's where most of the migrants come immediately. The majority of them are renting for the data shows about the first 3 to 4 years they're renting. They're the markets which will benefit from the rental side of things. But I think from a growth side, as long as there's not too much tinkering with regards to the price of money and restriction to access to money, I think we're going to see everything from the entry-level markets to the mid-tier markets and the higher-end markets still fare very well, because we haven't seen that extra level of migration put the pressure on the market. It's only really just been Australians buying property in Australia as what's pushed up this boom. And I don't think we'll see the same mass exodus. We'll see holidays. I think people are definitely going to chomp at the bit to get out of here for a nice fancy holiday. But I don't think we're going to see the same amount of people in their mid-20s to mid-30s and up to their mid-40s go overseas for that promotion over the next few years, the same way we probably were seeing over the last couple of decades.
And what about with the change to the shift towards this kind of working from home culture, all of those kind of places, those regional places like your Byron Bays, your Noosas, Southern Highlands, things like that, they've obviously gone off the charts. These kind of lifestyle towns, so to say, do you kind of see that trend continuing? Is this a new normal for people working those 2-3 days a week, being able to live that bit further out in those nicer parts?
I was listening to an economist who is also a demographer give a really interesting talk on census data, and probably referring back to, we've obviously just had our census, which we won't see the true data of that and the details of that for at least another year or so, but talking about the previous census data to where they expect this to flow onto that exact question of where are people going to work and what's going to be the new norm, considering working from home's pretty much been forced on a lot of professional services sectors these days. Will it go back to working from an office? I personally highly doubt we'll go back to any kind of mainstay of what we saw 2 years ago. I think we're going to see that hybrid will become a permanent stalwart. And you see the big companies of the Apples, the Silicon Valleys, a lot of the banks, a lot of the tech companies in general are leading the charge to saying that they're probably going to put some defined days in a calendar that they expect their team to be in an office. I think that's going to be a lot of the new norm. So what does that mean for where people want to live? The reality of Noosa and Byron and the Southern Highlands and pretty much anywhere up and down the East Coast that's an attractive coastal town, they are expensive. It doesn't take much to go and look at any of these markets and say, wow, those prices, you're really looking at premium major city location equivalent price points. So what I think we're going to see is that those places won't fall off a cliff, but you're going to see that sort of 15, 20, 30-minute radius of those really attractive markets. So if you go to Byron, you're looking at some of those radius markets all the way out to places like Lismore, Gunnellabar. If you go up to Noosa, then you're looking at sort of more in the highlands out towards as far as Gympie and some of the areas a bit further down towards the Sunshine Coast. And Southern Highlands, you've sort of got some of those areas that even sprawl as far as Goulburn and a little bit further down towards parts of the lower Illawarra. That sort of every market's got the equivalent. If you're going to the West Coast, you've got the same thing around Broome down towards Margaret River. Every market will find that. So I think they're probably the markets that'll probably do better over the medium term because rents are a little bit more affordable. They've still got access to those major amenities, lifestyle aspects, but prices are affordable. So if you're equivalent on a decent income, and you're thinking, well, I don't want to raise my family here because A, it's crazy expensive, B, I don't need to be here and we can still do everything we need to do. I think they're the ones who are going to seek those sort of $600,000 to $1 million price bracket properties. They're the ones that are probably going to see a lot more consistency and a lot more demand over the next couple of years.
Yeah, right. And I guess when we're looking into the, short term, especially, early next year, we've got an election coming up. We've got a record deficit that needs to be kind of, paid off, obviously. If the green light is given to the ATO to begin collecting, are you thinking that this is going to cause any sort of a flow-on effect in regards to defaults, forced sales, anything like that?
I mean, the only real way that we sort of really consider where are we going to be in the 5-10 year time from cash flow perspective is looking at those long-term bond rates, et cetera. And as much as they've seen a bit of an uptick recently, I mean, the US Fed sort of recently gone out and said they're going to hold off on any kind of extended period to start looking at interest rate rises. I think it would have probably started by the end of this year if Delta didn't rear its head. And we've now got the Gamma strain and all the other things that are probably going to come from the next 3, 4, 5 strains. We've got issues in regards to I think we've got issues in regards to places like Africa and a lot of the third world countries and the developing countries where you've got vaccination rates sub 5% and no real emphasis from the WHO to really say we need to change that, because that's where you're going to see more and more of these new strains get developed and spread. And I think that's going to be a problem for the world in general. So I think we need to put more emphasis there. But where it leads to cash flow and money, I personally don't think we're going to see us moving upwards of 5-6% interest rates in the next decade, hands down. I think we'll probably find a new floor at about that 0.5 to 1% above where we are now in the next 3 to 4 years. But we're in this low interest rate environment, in my opinion, for probably the next 5 to 10 years pretty consistently. So this is the flow-on effect when you get asset values increase, and it's definitely not just increasing in Australia; it's increasing globally.
Yeah,
the world knows that you can't just all of a sudden go and throw. Inflation will be something that has to be managed, but I don't think you can go and throw a 2 or 3% interest rate hike over a 5-year period, because it will lead to an asset bubble and an asset crisis. So yeah, I think we're pretty much factored in that cash is going to stay relatively cheap. We've found the new normal, and they're going to need to keep it cheap to keep investment into the market as well.
Yeah, because there are those countries over in, Japan, Germany, things like that have had these, record low interest rates or even, positive interest rates for, 12, 15 years. Do you think that is just kind of the environment we're getting to? Obviously, the RBA, they promised what it was 18 months ago that they wouldn't be touching interest rates until 2023. You're still confident with that? They won't kind of move anything in the next 18 months?
I think so. I think 2023, 2024 is probably when things will probably move to the more positive. I'm not ruling out another cut. I don't think whether that means anything material for borrowers probably remains to be seen. It probably won't. I think they want to keep the confidence more so with the big four and the mid-tier banks to make sure that they know that their cost of funding is going to stay cheap. And I think they're going to need to do that. The government's going to know that this has to be the way, because we've got huge amounts of debt that needs to be paid back. Obviously we want to make sure that debt's paid back at a pretty low interest rate as well. And the globe's not in a dissimilar position. There's a lot of countries with a lot of leverage, and we've actually got one of the lowest level of leverages versus GDP. So I personally think that, it's going to stay low. The emphasis on so many different levels is going to mean that it has to stay low, not just in Australia, but globally. So I'm confident that where the record, even though we'll start to see the doomsdays come out and say we're at record levels of debt versus household income, it's all relative to what that debt's worth and what that costs. Now, if that debt was to get twice as expensive overnight, then we've got a big problem, but that's just simply not going to happen.
Yeah, sure. Absolutely. And you also touch, your business itself. You guys do, a bit of commercial stuff as well. Obviously the CBD office market is one side of things, but also you also have looked very closely at a lot of those kind of suburban commercial assets and things like that. Just very quickly, how do you think they will go long term? Because they are very two different markets, CBD commercial offices compared to those industrial assets you're looking at.
Yeah, the CBD office market, and even sort of the office markets in sort of the regional towns or the satellite towns or the sort of the larger LGAs of major metros, they're still for me a question mark. I think that especially anything that's sort of 4 or 5 stories and beyond, I still don't personally have any confidence in what that looks like and what that model is right now. Similar to what that strip mall retail market is, like it's hard to define what that's going to end up eventuating into, because the properties are there. A lot of them are in prime position and they're desirable, but they're just not purposed correctly at the moment. And I think the market has to figure out what they're going to be used for before we're going to be confident in them. On the flip side of that, things like industrial, commercial warehouse, bulky goods, storage, high clearance, sort of that 80 square meters to 300 square meter size is a market that's absolutely booming. And that's a market that we've seen, obviously, the e-commerce side of the world is absolutely on fire at the moment. That's not going to change. Trade sector, given the investment into infrastructure, you're going to see trades absolutely booming, from small carpenters right through to mid-tier civil companies and people who need to have mass storage for things like scaffolding and materials, and also mezzanine, office, that type of thing. So we're seeing that market's seeing a massive amount of actual squeeze of actual where their actual cap rate is. So we're seeing properties that were transacting this time last year for a tenanted 3+3 lease, sort of, let's say in the middle rings of Brisbane, would have traded at 6.5-7% net return. That same property now with that same lease will probably trade at about 5.5 to 5.8% net return. So you're kind of seeing the equivalent growth of the best part of 20% in that year on a value proposition as well. So yields will stay squeezed while money stays cheap, and the demand for those properties are there. For me, that's probably the pick of the sectors if you were sort of getting into that type of market.
Yeah, interesting. Very good. And mate, just to finish up, we're all trying to keep busy during lockdown. And mate, you're out there every morning at the moment, surf aid with your son, are you, mate? You're trying to surf every single day in September to raise a bit of money. Is that right?
Yeah, mate. Yeah, we're committed. My boy, was his choice. But yeah, it was sort of something that we wanted to do something, and he loves getting in the water. He's 7, so he's sort of still learning his craft. But he's been surfing for probably the best part of 4 years. He's been there since he was about 3. But we're committed to surf every day in September. He did cut his foot pretty badly on an oyster a couple of days ago, so I had to pitch in for a couple of days and surf on his behalf. But he was back in as of yesterday. We're up to $6,000 we've raised now. So essentially, also my company's going to essentially put $100 in for every property we secure for the month of September. Billabong have also agreed to double anything that we raise as well. So we're in a really cool position that we've raised $6,000 in the best part of a third of what we do. Our target was only $2,000, so I think we're going to reset our target to ideally probably up to $10,000. So the intention of Surf Aid, I'm an avid surfer, and surfing's given me a lot in life, and the Surf Aid's role is to essentially give clean running water and also sanitary positions to remote surfing communities around the globe. So for me, it's a great cause. It's not giving money to communities per se. It's building infrastructure to give both the current environment and community there a better life, but hopefully generations to come, because they give so much back to people like me, and I want to ideally give my son a chance to know what it's like to give back to those communities. Ideally at some stage in his life, he's going to be able to go and experience, and I've done plenty of travel to surf and enjoy it as well. So it's a great little cause. If anyone wants to get behind it, they can either jump on a Surf Aid, or they can jump onto Pure Property Investments Instagram page. We've got a link in our bio, which takes us straight to the donation page as well. So noting that every single penny will go straight to a remote community and help them give them clean running water.
Fantastic, mate. That's excellent. And if anyone's interested in regards to any more information on property investment, I know you've also got your book, The Surfer's Guide to Property Investment, which I've read. It's a cracking read. It's good stuff. So I'm sure you can contact Paul if you'd like a copy of that as well, mate. Thank you very much for your time. I appreciate it. And mate, let's hope we can get out of this situation and meet face-to-face
stuff. Absolutely. Thanks for having me, bud.
Thanks, mate. Cheers.